Wall Street's biggest tech investors are quietly buying the dip, but not in the companies you think. Nvidia, too volatile. Meta, strategic timing. And there's one sleeper pick that could explode in 2025. Stick around, because this might be your edge in a chaotic market. Welcome back to the channel, where we decode the moves of top institutional investors and how they're positioning for the next wave in AI, chips, and recession-resistant tech. Today, we're dissecting why big money is pouring back into semiconductor giants like Broadcom and Meta, while also highlighting surprising defensive plays like Netflix and even Berkshire Hathaway. More importantly, we're revealing the key indicators that tell us whether the storm in tech is just beginning or nearly over. Nvidia's stock has been a battlefield. Just recently, price targets were slashed again, UBS cutting from $185 to $180, and yet the stock hovers around $100. But here's the twist. Seasoned investors aren't running from Nvidia. They're timing it. Despite poor news flow, declining sentiment, and export control fears, insiders see a recovery in the second half of the year. Why? Because demand for AI accelerators like Nvidia's chips hasn't slowed. It's just shadowed by policy turbulence. Let's talk about fear. Measurable fear. The VIX recently touched 60, one of the highest levels in years. This signals mass capitulation and forced de-risking by hedge funds. Think of it this way, when the VX explodes, so does opportunity. If markets stabilize, even marginally, Nvidia could rebound to $115 or more in just a few weeks. And if AI earnings surprise to the upside, that jump could accelerate. So where is capital moving next? One name keeps coming up, Broadcom. Why? $10 billion share repurchase. Undervalued assets. And they're sitting at the heart of the AI infrastructure build-out. Think servers, data centers, 5G. Everything AI runs on. Next, Meta. Not for social media hype, but because of its ad tech AI tools. In a downturn, companies don't stop advertising. They become more efficient. Meta's AI does exactly that. Less spend, better targeting. That's why this fund increased their position this week. Not for today's results, but for dominance during the next recession. Now here's something that might surprise you. Netflix. New position, new opportunity. Because when consumers cut costs, guess what they keep? Their $15/month escape from reality. Despite some slowing growth, Netflix projects a revenue jump to $10.4 billion and a $5.74 EPS this quarter. That's not contraction, that's resilience. And finally, a sleeper pick with a surprising name, Berkshire Hathaway. Why would a high-growth tech fund buy into Berkshire? Because they see value in calm, cash-rich, diversified holdings, especially ahead of potential rate cuts or economic tightening. Their thesis? When the market shakes, the Oracle of Omaha steadies the ship. And on May 2nd, Berkshire's earnings could send ripple effects through investor sentiment.
So, here's the playbook. Nvidia. Watch for earnings, watch the VIX. Broadcom and Meta. Quiet accumulation now. AI catalysts later. Netflix, stay-at-home king, again. Berkshire, your hedge in a storm. Nvidia is more than just a graphics card company. It's a global leader in AI, data center solutions, gaming hardware, and autonomous driving technologies. Let's start with the fundamentals. As of Q2 2025, Nvidia's market cap has surpassed $3 trillion, making it one of the most valuable tech companies in the world. Its PE ratio is high, sitting above 70. But that's expected from a hyper-growth tech firm with strong pricing power and unmatched innovation. Let's talk numbers. In the last fiscal year, Nvidia generated over $80 billion in revenue. That's a plus 250% increase year over year, driven mainly by AI-related demand in enterprise GPUs. Net income is now above $35 billion, and free cash flow has remained very strong, exceeding $26 billion. A healthy sign that the company is both profitable and cash-rich. Nvidia's growth isn't random. It's built on key strategic projects, AI and data centers. Nvidia's Hopper and Blackwell GPU architectures are now standard for AI model training. With partnerships involving OpenAI, Google Cloud, and AWS, Nvidia is the backbone of the global AI boom. Omniverse platform. This real-time digital twin platform is being adopted by BMW, Siemens, and other industrial giants to simulate factories before they're built. A revolution in industrial planning. Automotive AI, drive platform. Nvidia is also powering autonomous driving technologies in partnerships with Tesla, Mercedes-Benz, and BYD. What excites investors even more is Nvidia's robust cash position. The company has more than $30 billion in cash and equivalents, and it's reducing long-term debt. Their free cash flow margin is around 33%, which means Nvidia is generating tons of cash relative to revenue. This gives Nvidia the firepower to continue R&D, make strategic acquisitions, and potentially increase share buybacks or dividends. If you're holding NVDA or thinking of buying, here's why the stock still has upside. AI isn't a trend. It's an infrastructure shift, and Nvidia is the leading supplier. Global expansion, including new data center contracts in Asia and Europe. High-margin business model with licensing, software, and cloud-related services increasing. Strong management team led by Jensen Huang, a visionary in AI computing. Possible stock split or dividend increase if the price continues climbing.
But it's not all smooth sailing. Keep an eye on regulatory risk, especially around AI chip exports. Competition from AMD, Intel, and custom AI chips by Amazon and Google. Valuation risk. NVDA is priced for perfection. Let's start with Meta's fundamentals. Meta Platforms, formerly Facebook, is a $1+ trillion tech powerhouse, with a PE ratio currently around 24 and an annual revenue exceeding $135 billion. Meta balances profitability with aggressive investment in the future. In Q1 2025, Meta reported revenue of $40.1 billion, a 14% year-over-year growth, and net income of $11.6 billion, signaling strong operational efficiency despite economic headwinds. Meta is not just about Facebook or Instagram anymore. The company is investing heavily in generative AI, LLMs like Llama and their AI assistant integrated across its apps. They're also doubling down on the metaverse through Reality Labs, with AR/VR hardware like Quest and partnerships in 3D digital environments. Although Reality Labs posted a loss of over $4 billion last quarter, it's a long-term bet on how we will connect in the future. Meta's free cash flow is robust, with over $12.5 billion generated in Q1 2025 alone. With $58 billion in cash and equivalents, Meta has the dry powder to fund its ambitions without relying heavily on debt. They've also initiated $14.5 billion in share buybacks this year, a strong signal of management's confidence in the company's intrinsic value. So what makes Meta attractive to shareholders? Strong core business. Ad revenue from Facebook, Instagram, and WhatsApp still dominates. AI leadership. Integrating AI into products keeps user engagement high. Aggressive innovation from smart glasses to virtual worlds. Healthy balance sheet, zero long-term debt and high liquidity. Shareholder returns, consistent buybacks, and a potential dividend in the future. In summary, Meta is more than a social media company. It's a data-rich, AI-forward tech ecosystem. If they execute their vision in AI and immersive tech, Meta could offer exponential returns in the long term. But like any value stock, it comes with less volatility. Smart investors should stay updated and think long term. Subscribe for more deep dives on market psychology, institutional moves, and the best strategic entries. And tell me in the comments, which stock are you watching for a breakout this year? For premium analysis and timely updates, don't forget to visit imam.com.